Good morning, everyone. Let's take a quick look at the latest developments across key financial markets, starting with the US dollar. So, last week, the US dollar faced pressure and briefly dipped below its lowest level since early October, largely in response to comments from President Trump suggesting that steep tariffs on Chinese goods might not last much longer. This hinted at a potential improvement in US China trade relations ahead of an anticipated meeting with President Xi Jinping. However, despite some late week gains, the dollar still posted a weekly loss, impacted by the ongoing US government shutdown, renewed concerns in the regional banking sector, and rising expectations of a Federal Reserve rate cut. Fed officials, including Christopher Waller and Stephen Millen, expressed support for the further monetary easing to mitigate the labor market risks and sustain growth. From a technical standpoint, the US dollar is showing signs of weakness, with support levels being tested and momentum indicators pointing to a temporary stall in its recent rebound. So, moving to crude oil, prices continue to slide for a third consecutive week. Both Brent and WTI crude saw over 1% weekly declines. Concerns about a possible global oversupply by 2026, highlighted in a recent International Energy Agency report, weighed heavily on sentiment. Additionally, the market reacted to news of a planned diplomatic meeting between the US and Russian leaders aimed at resolving conflict in the Ukraine. This development eased fears of a global energy supply constraint. This contributed to the bearish outlook. Technical indicators suggest that oil remains in a weak consolidation phase, with prices trading below key moving averages and momentum indicators confirming a bearish bias. Now on to gold, which experienced a slight pullback of about 2% after reaching an all-time high of over $4,370 an ounce. The dip came amid easing US-China tensions, with President Trump suggesting that a full-scale tariff escalation was unsustainable. Nonetheless, the broader trend remains bullish. Gold has climbed over 60% this year, driven by safe haven demand, expectations of Fed rate cuts, and central bank purchases. Technically, the market remains in a strong uptrend, with prices supported above the key moving averages. While some short-term corrections are likely due to overbought conditions, the overall sentiment remains positive and the potential for upside targets are still in play. Lastly, turning to the Australian dollar. It fell sharply last week, dropping below the 65-cent level following weaker than expected employment data. This spurred speculation of a rate cut by the Reserve Bank of Australia, with markets now pricing in a high probability of easing. Despite pressure from domestic data, the Aussie found some support from a weakening US dollar and hopes of an improved US-China trade relations. From a technical perspective, the Aussie-US pair remains bearish, trading within a downward channel and showing negative momentum indicators. Key support levels are being tested, and further declines could occur unless there's a break from near-term resistance zones. So, in summary, markets remain heavily influenced by geopolitical developments, central bank signals, and technical trading patterns. As we head into another trading week, keep an eye on upcoming US-China and US-Russia talks, as they could prove pivotal in shaping market direction across currencies, commodities, and safe haven assets. Thank you and good luck out there.